watch this earnings season is in the best performing sector of the last 2 years. It's energy. I don't think I've ever done a pure energy earnings all stars video, even while it's been hot. Or maybe I've only done one or two over the years because everybody hates energy, right? And we rarely even look at the charts, even of big oil. But now I think we should because energy has come way down. We had a decline in natural gas, and WTI and Brent crude have come way down. And so a lot of people have abandoned the sector here in 2023. But is that a mistake? I'm going on the record saying that I believe energy will be the best performing sector for the third year in a row. Maybe I'll be wrong, but I'm liking my odds, even with the bad start to the year. What do these earnings charts look like? Which companies should you be watching? I pulled out five of the big cap energy names. These are among the first that are going to start reporting. These will give us an idea about what's happening out there. But one thing to look for these energy companies is earnings are going to decline because they're coming off of the Ukraine war quarter last year and those record high commodity prices. So we already know that those earnings are going to come down. Also, any of these companies that are paying variable dividends, not just the standard dividend, but the variables based on those high free cash flows, that's going to come down. And it has been over the last several quarters, but it's going to come down again. But these things are beholden to the commodity prices. So we've already seen WTI retake $80 here in the second quarter, but that won't be priced in on any of these companies, until later on this year. So this quarter, I do expect the earning or the dividend yields to come down quite a bit and not be quite as generous as we've seen over the last year. However, these stocks remain cheap, and I'm bringing you five of the big names that are going to kind of kick it off. So let's see what those are. So I'm kicking it off with SLB, ticker SLB. And as you can see here on Zacks.com, we're still calling it by its old name, Schlumberger, but they did change their name to SLB. And you might be wondering why. Why are they doing this? Because they do consider themselves to be a technology company. And so they kind of wanted to shed their old identity under Schlumberger and start a new one. But this company is on the services side, and they do deploy tons of technology on the services side for the drilling and all of that. And they hire software engineers, for goodness sakes. So that's why they want to focus on that side of the business. But they are a global company, and we're seeing energy production, including drilling, increasing globally, and that's a good sign for a company like this. You can see that it went down, down, down heading into 2020. Even before the pandemic hit, these shares were under pressure because energy was still in a bear market, and the services side, which is SLB, was getting hit. People were drilling less, so they weren't able to grow earnings or revenue in that the way they wanted to in those years. But these companies are cyclical. Now we've entered into the new cycle and everybody is drilling. So who are they going to call? They're going to call Schlumberger, or now SLB. It has an outstanding earnings surprise track record, as you can see. No misses in 5 years, even during the chaos of the pandemic when oil went negative. This is super impressive. Great management to finesse their earnings enough and be forthright enough with the analysts so that the analysts have a clear understanding of what is going on with the company behind the scenes. So that's what it takes to get an earnings surprise track record that looks like this. Even if some of these quarters was an earnings meet, that's still impressive over this long time period. Now, what are the shares doing? Year to date, they're down 1.8%, but you can see there in 2023, they had a bigger dip. They're now off that dip, and that was on WTI and Brent pulling way back, and WTI basically testing 65. So the bears got a little bearish there, but now with it back up over 80, it has bounced a bit. 2 years, though, these shares are up 99.6%. So they basically doubled in 2 years. Can they double again? They are fairly cheap. They have a forward PE now of 17.4. So some of the good news and this stage of the cycle are priced in, but you normally don't get a top at the early stage of the cycle. You get it at the end. And I believe we're still in the first couple of innings of this energy cycle. Then we're going to switch over to one of the other big service side stocks. I own it in the Zacks value investor portfolio, Halliburton, ticker HAL. They haven't changed their name. They're still Halliburton. They too have an outstanding earnings surprise track record. As you can see, they only have one miss, and it's back in 2018. Otherwise, they too navigated the very tricky pandemic 2020 year, and now they've come out of it as well, as demand for their services has increased the same way with SLB. Year to date, however, these shares are down 14.5% on that pullback in crude and natural gas prices. All the energy stocks were mostly sold off. That's what happens when you're the best performing sector for 2 years. Everybody takes profits at some point and gets out, but this is a buying opportunity in the stock. It's very cheap with a PE of just 11. And over the 2 year track, it's up 62%. So that's quite a nice return if you've managed to hold on for these big pullbacks. You can see the big one in 2022 and another one here in 2023. So you do have to have a strong stomach on these service stocks because people get a little panicky when you have a pullback in the commodities. But again, we're in the early stages of the cycle. Halliburton's free cash flow has really improved. It is outstanding here, and that's what you want to see as a owner. Now we're going to switch over to the production side with Pioneer Natural Resources. Many of you might never have heard of this oil producer, except in recent days, there have been stories that maybe Exxon is in talks with them, just talks about a possible acquisition. But Pioneer Natural Resources is one of the largest of the independent explorer and production companies in the United States. It is the biggest player in the Permian Basin, or at least one of them. That's one of the premier oil, reserves in the United States. And so this company is one of the industry leaders. It also has excellent management that's been around for decades. So people do look at it as a leader here. They have a good earnings surprise track record, as you can see. They've only had two misses since the pandemic started, and otherwise a lot of just meets or slight beats in there, which has not been easy to do on the production side. But you can see these shares coming off those highs in 2022. That is the Ukraine war high earlier in the year. But as WTI natural gas have come down, so have the shares. That's normal for these E&P type of companies. But shares got kind of oversold there here in 2023. They were at 52-week lows. And that's when the rumors started kind of appearing that they are in the talks with Exxon. So are they in the talks? We're about to find out as this company reports this month. But they have bounced off those lows on these rumors, and they were just oversold. Year to date now, they're up 0.7% or about 1%. So not doing that much this year, but you did have a real buying opportunity on the sell-off. Over the last 2 years, however, now up 55%. But that's what happens when you're in the best performing sector of the last 2 years. The stock is showing it. Stock is still cheap at 10.8 times on the PE, and it pays one of the highest dividends in the industry. During part of last year, it was paying out a yield as high as about 18%. That's come down, as I mentioned earlier, because the earnings or the commodity prices come down. So have the earnings, so is free cash flow. They are unhedged. So as that comes down, they're going to make less money, even if they're drilling more, but they're going to make less. So the dividend yield has come down, but it's still among the best in the industry. It was still over 5% last quarter. They are paying out anywhere over like 80% of their free cash flow has been going back to shareholders the last couple of quarters. They didn't commit to doing 100% like they did last quarter, but they're doing it nevertheless. They're very low debt on their balance sheet. That's why I like Pioneer. I own them in my own individual portfolio and in the Zacks Value Investor portfolio, if for nothing else than that really great dividend yield that they're paying out. So Pioneer, one to watch. It's kind of the big guy, the clunker, but Scott Sheffield, the CEO, is one of the industry leaders. He's kind of like the Jamie Dimon of the producers, of the oil producers. So we'll be tuning in to hear what he has to say about what's going on out there in the industry. A couple weeks ago, he did predict WTI would be back at around 90 this summer, and it is at over 80 here in April. So will he be right? If he is, the free cash flow will be quite nice once again at Pioneer, but we will see. Then we're going to switch over to the big oil. So what's the difference between like an Exxon Mobil, as this chart is showing, and a Pioneer? Pioneer does not refine its own products. It doesn't have a chemical company. All it does is explore and drill it out, and then it sells it to other people. Exxon Mobil drills it out and gets it out, but it also can refine it, and it has, pipelines and things. It can distribute it, move it around. It has service stations where it then sells the gasoline. It also is one of the largest chemical companies in the United States. So that's what they mean when they say big oil, or a big oil integrated. It's integrated amongst all the different levels of energy production and refining. So that's ExxonMobil, and they're still one of the big kahunas in energy in the United States. They beat 3 quarters in a row now. They've had a little bit choppier earnings surprise record, but that's kind of the case because there's a lot of moving parts with big oil. When chemicals are doing well, maybe refining is not. Maybe those crack spreads aren't good. Maybe the consumer's buying less gasoline, so the service stations aren't that great. Or the price of oil goes down, or natural gas. Exxon also has a big natural gas division. Surprisingly, the shares have not pulled back that much here in 2023, even though natural gas has plummeted and oil came down considerably. People have remained bullish on this one and are kind of sticking it out. Year to date, the shares are actually up 5.2%. And over the last 2 years, they're up 105%. So it's been quite a run. And some people are saying, oh, it's overdone now. But again, I believe we're still at the early stages of this energy cycle. And usually these stocks do not peak at the early stages. But we will see going forward. What will they say is happening out there? We'll see. They pay a nice dividend. They do not, so far, have not paid out a variable. They have been buying back a lot of shares, and they're sitting on, I think, close to 30 billion in cash right now. Will some of that be deployed to buy out a smaller competitor that has big reserves in the Permian? We don't know. We're just hearing these rumors, so this is one we're going to have to watch. Then we're switching over to its competitor, Chevron, also big oil, ticker CVX. That we're going to get both of these right in a row on the same day, and then we'll hear from more of the independent exploration companies like Pioneer. But these two big integrated oil companies will set the tone. Chevron, a little bit choppier with its earnings surprise record the last 2 years. That's kind of surprising because they always actually were better than Exxon at meeting or beating, but now it has been reversed. They are coming off a miss last quarter, and these shares also pulled back. I do consider that to be a buying opportunity because they got cheaper than ever. They're trading with a forward PE of just 11.9, so that's still on the cheap side. Remember, at the top of the cycle, they will have sometimes lower PEs at the top of the cycle, but we'll see. But a lot of times that PE will expand if the earnings can't keep up with how bullish everybody is on the stock. But year to date, the shares are down 3.9% over the last 2 years, up 67%. So not quite as good a return as Exxon, but they too pay the big dividend and they have been buying back shares as well. Will they buy out someone? A lot of these companies, they've got a lot of cash and they are looking for those reserves. It's just a quicker way to build up production if they just buy out the smaller players, especially ones where everybody knows where the oil is hidden. So Chevron, another one to watch. Will it bust out of these ranges for any of these energies and go to new highs later on this year, especially if oil and natural gas prices, reverse and start to move higher, as some predict may happen, but we'll see. If that happens, then we could be very bullish on these stocks once again. But a lot of things up in the air, and I'll be watching all of the energy this earnings season. So there's a lot going on in energy. You don't want to miss a single one of these earnings videos because I'm covering a lot on all of these companies, including more on the FANGs and the FANG men. We're going to get Microsoft and some of the other big names coming up. So you want to be sure to subscribe. Get all of our videos on Zacks.com/YouTube. I'll be tweeting them out on my Twitter page. The Zacks Twitter page will also be tweeting them out. But be sure to get us somewhere, and I'll see you again next time with some more earnings charts.